Hey everybody, I am Janie Milioto and this is my Bloomberg-based project for Finance 451. I chose to use 5 companies from the medical industry and 5 companies from the construction industry. I performed time trend analysis and peer group analysis within each of these industries. First, we're going to look at the medical industry. Let's take a look at the short-term solvency ratios for the medical industry. Penumbra seems to like to keep lots of cash on hand considering its high cash ratios historically. This company can definitely pay off its current liabilities with cash and cash equivalents. We know that current ratio is going to be current assets over current liabilities. Penumbra has a very high current ratio historically, so this company can most certainly cover its current liabilities with its current assets. We can subtract off inventories and take a look at the company's quick ratio. Inventories are not the main driver in Penumbra's current assets because after subtracting them off, the company still has plenty enough current assets to cover its current liabilities. So overall, Penumbra has very high short-term solvency ratios historically, and it seems that they are going to continue having high short-term solvency ratios. So as you can see here, Johnson & Johnson's cash ratios are not as high as Penumbra's are, but they still have a good bit of cash and cash equivalents available to cover current liabilities. In 2017, the company's cash ratio started to decline and looks like it's going to continue to decline. Maybe they decided to start investing cash into other things. Looking at Johnson & Johnson's current ratio, the company does do a great job with covering current liabilities with current assets. Just like the company's cash ratio, though, the current ratio seems to be declining. When considering Johnson & Johnson's quick ratio, it doesn't seem like the company is relying too much on inventories because there's not a dramatic difference in the company's current ratio and its quick ratio. Abbott Labs' low cash ratio shows that the company does not like to keep excess cash on hand. So just like Johnson & Johnson, they may be investing their cash into other things. Just like every other company in the medical industry, Abbott Labs has plenty enough current assets to cover its current liabilities. And not much inventories. As you can see, the current ratio and the quick ratio are not that much different every year. So if you look at Stryker Corp and Medtronic, the same goes for these two companies. A good bit of money in their cash ratio. Current and quick, not that much different, but they're both really, they're good numbers. And then we look at Medtronic. They keep, 2014 they had a lot of cash on hand, and it seems to decline. But, they're still keeping a good bit. Great current ratio, quick ratio, not much different from the current ratio. So it seems that all companies in the medical field have more than enough current assets to take care of their current liabilities, and not much of that comes from inventories. Companies like Penumbra and Medtronic keep excess cash on hand at all times, but companies such as Johnson & Johnson, Abbott Labs, and Stryker Corp may be investing their cash into other places. Those 3 companies are not as liquid as the others, so this may be a red flag for investors because those companies may not have excess cash and cash equivalents on hand in case something goes wrong. So I would say that's the only downside of not keeping as much cash on hand as the other 2 companies that I've analyzed, but like I said, it's not always a bad thing. So now we can take a look at the company's profitability ratios such as profit margin, return on assets, and return on equity. Penumbra is the one company out of the medical field that has a very low profit margin historically, which can be pretty scary for investors. Bloomberg does estimate this profit margin to increase over the next couple of years, but even in the estimated profit margin in 2019 and 2020 are still fairly low for a profit margin. So even the company's return on asset and return on equity, common equity, are low. So, this would definitely scare investors away. But like I said, Bloomberg is expecting these numbers to increase within the next couple of years. But, like I said, that is just an estimate. That's not guaranteed. So it seems that the company's low profit margin is driving its low return on assets because the company does have a pretty good asset turnover historically. Johnson & Johnson's profit margin, on the other hand, is considerably high, which, also their return on assets and return on common equity are also high historically, which I really like. The only thing I don't like here is the company's 2017 numbers. They all fell very low and then jumped right back up high in 2018, which, I guess you can say they made up for their loss, but it's, you still don't like to see a dramatic decline and then a dramatic incline. Johnson & Johnson has a pretty low asset turnover, so this could be why its ROA is not as high as you would think it would be since its profit margin is so high. Abbott Labs' profit margin, return on assets, and return on equity are pretty low except in 2015. The company had numbers that year that investors would like, but just like Johnson & Johnson, Abbott Labs' numbers fell very low in 2017. They did jump back up in 2018, but they still weren't what I would call good numbers. Bloomberg does estimate Abbott Labs' profit margin, ROA, and ROE to increase in the next couple of years. Abbott Labs has a very low asset turnover and a pretty low profit margin, so this is why its return on assets is pretty low. Stryker Corp's numbers in 2014 were very low, but have continuously increased every year except 2017. I'm starting to see a trend here. The medical industry took a hit in 2017. Stryker Corp's numbers didn't fall as low as the other companies, but they did, you can see here they definitely did fall and then jump back up. Overall, Stryker Corp has been improving every year when considering profit margin, return on assets, and return on equity. Just like Abbott Labs, Stryker Corp has a low profit margin and asset turnover, which is causing its ROA to be low, which is a pretty big turnoff to investors. Medtronic's profit margin has been high historically. This company also has a good ROA and an ROE. Its ROA and ROE are not as high as the other companies in this industry, but they are average, which is not bad at all. Investors see this sort of as a promise. They've been historically the same over the past year, so you kind of feel like you're promised this certain return. So this is the only company in the medical industry that did not take a hit in 2017, which surprises me. This is something I like about this company. Medtronic has good profit margins historically, but its asset turnovers are continuously declining, which is driving its ROA down. Let's go back up here and talk about the price to earnings ratio. Generally, a high price to earnings ratio means that investors are anticipating higher growth in the future. Penumbra has consistently had a very high price to earnings ratio, so clearly investors are expecting this company to grow exponentially in the future. Johnson & Johnson and Medtronic have around the same numbers for their PE ratio, and their numbers are pretty good historically, but they're much lower than Penumbra's price to earnings. But like I said, they're pretty good, so I don't see anything wrong here. But a high price to earnings ratio is not necessarily a better investment than a company with a low price to earnings ratio, because a high price to earnings ratio can indicate that the stock is being overvalued. If we look here, we see that Penumbra's stock is very overvalued. It's currently overpriced by $129.83. And this could be what's driving their price to earnings ratio to be so high, which, when an investor sees how overvalued a company is, it could be a red flag for them, something they don't like. So most of the companies in the medical industry have financial leverage that is pretty stagnant. I never noticed a company that their financial leverage changed drastically. But it does seem that Johnson & Johnson is using more financial leverage to acquire additional assets. So this could be driving some of their numbers to change. This could be why they're keeping less cash on hand maybe, or, it's definitely driving some of their numbers. So finally, we're going to look at the medical industry's economic value added. This is a market value, so this is the first number we've talked about that comes from the market rather than the accountants. So one company's economic value added that stood out to me was Johnson & Johnson's. As you can see, it is very high. So this company's economic value added has been positive and very high except every year except 2017, which we've already discovered. This means that the company is producing lots of value from the funds invested in it. On the other hand, Abbott Labs' economic value added has been largely negative historically. This means that the company's not generating any value from the funds that are invested into the business. So this is another thing that can be a turnoff to investors. I'm not saying that it needs to be as high as Johnson & Johnson's is, but Abbott Labs numbers are extremely low. So if we look at the dividend discount model for the medical industry, we see that all 5 of these companies are overpriced today. Overpriced by $130, overpriced by $4, overpriced by $35, overpriced by $111, overpriced by $20. So it would not be a good time to buy stock in these companies, but this may be because the market is expecting increases in the medical industry stock prices in the upcoming years because of new technology. So they are overpriced or overvalued, so it would not be a good time to purchase these stocks, but it may not necessarily be a bad thing. So after analyzing these 5 companies in the medical industry, I would have to say that Johnson & Johnson is my favorite company in this industry and the most promising. The company shows that they are liquid by its cash ratio above 1 from 2014 to 2016. It does drop below 1 in 2017 and 2018, but it is still above 0.5, so they can still cover at least 60% of its current liabilities with cash and cash equivalents if something were to happen. The company has a good current and quick ratio historically, which is always good to see. The company does not have much financial leverage, but we do see that they are continuing to increase its debt, which isn't necessarily a bad thing because, technically they're using someone else's money to run their business. The company does not have a good asset turnover, so they do not use their assets as efficiently as I would like, but none of the companies in this industry do, so you kind of just have to, pick your poison, I guess you can say. It seems that all companies in the medical industry have an asset turnover around 0.5. The only, upside to Johnson & Johnson is that its large profit margin makes up for the low asset turnover, whereas the other 4 companies don't have a high profit margin like Johnson & Johnson, so it causes their ROA to be low, while Johnson & Johnson's is pretty high. So the company's high return on equity is driven by its high tax and interest burdens. A high return on equity is good to see. The company is also creating a bunch of economic value from the funds that have been invested in it. So next we're going to take a look at the construction industry. So after analyzing these 5 companies in the construction industry, I did notice that all of their cash ratios are very low. The highest cash ratio out of all of these companies was, from KBR in 2015, and it's still only 0.63, which, that's not high at all considering the cash ratios that we saw when we analyzed the medical industry. Like I said, this is not necessarily a bad thing because maybe these companies feel they don't need to keep excess cash on hand, or maybe they're investing it elsewhere. So if we take a look at Mastech's cash ratios, you can see what I mean. Look, they are super low. Scary low. This is sort of a red flag for me because these companies don't have cash to take care of their current liabilities if something were to go wrong with their companies. It shows me that, the companies are not very liquid. But, let's take a look at some other short-term solvency ratios. All 5 of these companies have around the same current ratio historically. I'd say that the average across the industry is, roughly 1.45. They're all around the same exact, 1.3, 1.4, 1.5, 1.6. Some are, 1.1. But, on average, they're very close to the same. These companies do have enough current assets to cover their current liabilities, and just like the medical industry, these companies' quick ratios are not far off from their current ratios, which tells me that they do not have much in inventories. The construction industry, like I said, is similar to the medical industry in this regard. So the outlier for the quick ratio, I would have to say, would be Jacobs Engineering, because their quick ratio is slightly lower than the other 4 companies, but it's not drastic. But it just may mean that they have more inventories than the other companies. Let's take a look at some profitability ratios. Another thing that stood out to me when analyzing this industry is that all of these companies have very low profit margins. That's not something I like to see. If we take a look at KBR, this company's profit margins, they fluctuate every year. 2014 super low, 2015 is low, but it, much higher than -20. You could see that, it's just up and down and up and down and up and down. This is a huge red flag because it shows lots of uncertainty to investors. Like you have no idea what kind of profit margin this company is going to have within the next year. Jacobs Engineering has a pretty low return on assets historically, which is driven by its low profit margin. The company's return on equity is also historically low, which seems to be driven by its low EBIT margin right here, because all of these other numbers, are pretty high. Just like Jacobs, though, Primoris has very low return on assets, which again is driven by its low profit margin. This company's return on equity is also historically low, which seems to be driven by its low EBIT margin. So I'm seeing another trend in this construction industry. Their low return on equities are clearly driven by the low EBIT margin. And then again, just like Jacobs, Primoris has very low return on assets, which is again driven by low profit margins over the past 5 years. This company has an average return on equity that seems to stay around 13%, as we can see right here. And, just like I said here, if I can find it. I don't remember. Whichever company was KBR, it was KBR. There, a lot of uncertainty with all the fluctuations, but Primoris, I like how their return on equity is, stays around 13%, because that is certainty, and that's what investors like to see. And this stagnant, I guess you would say, return on equity seems to be driven by its tax burden and EBIT margin, that both of those numbers seem to stay the same over the past 5 years. It seems like KBR had a really bad year in 2014 because of how low their numbers were. This company's returns are very volatile historically, which is something I don't like to see when it comes to returns. This current company's returns seem to be driven by its uncertain profit margin. So like I just said a few minutes ago, this is, honestly, if you look at all the numbers, they're just everywhere. I don't think I can find one thing, maybe besides its short-term solvency ratios that don't change drastically over every year. So AECOM has very low returns, which also seem to be driven by low profit margins. Since 2016, Mastech has had a really nice return on equity. and this is due to the increase in EBIT margin and profit margin. This company also has pretty good ROAs after 2015, and this is driven by better asset efficiency after that year. The only company that seems to be creating economic value is MasTec, even though their numbers are slightly above zero, as you can see here. These small positive numbers are better than the other four companies' large negative numbers. If we take a look at the construction industry's dividend discount model, Primoris and MasTec are currently underpriced or undervalued, so it would be a good time to invest in them. The other three companies are currently overpriced, so it wouldn't necessarily be a good time to invest in them, but like I said, this isn't necessarily a bad thing. I would have to say my favorite company from the construction industry is MasTec. Since 2016, all of this company's numbers are promising and consistent. Basically, you know what you're going to get if you were to invest in this company, if there are no surprises, of course. The only downside would be that it seems they don't have much excess cash, but the good returns and asset efficiency tell you that, it seems the company's doing well. So it kind of their returns make up for the small cash ratios. The company has improved and is continuing to improve its asset efficiency, which is something I always like to see, especially because it is resulting in higher returns. Also, this company is currently underpriced by $4.20, so it would be a good time to buy stock. For my overall favorite company, I would have to jump back over to the medical industry and choose Johnson & Johnson. Besides this company's bad year they had in 2017, I like everything else about them, especially because they showed they can come back from a bad year and continue their promising numbers they had before that year. I will explain in more detail all of the things I like about Johnson & Johnson and what exactly happened to the company to make their numbers drop drastically in 2017 in my sell-side report.